PhD here. He was one of the kind of role models like that we students used to look at his work, his publications, which are all published in top journals at that time. And he continues that record of publishing good quality papers in these areas of international trade, foreign investment, and related industrial development and related areas. Professor Nagesh Kumar is the director and chief executive of the Institute for Studies in Industrial Development, New Delhi. He also serves an external member of the Monetary Policy Committee of the Reserve Bank of India. He is also non-resident senior fellow of UNU Wider, Helsinki, and the Boston University Global Development Policy Center, Boston, USA. Professor Kumar earlier served as director at the United Nations Economic and Social Commission of Asia and the Pacific, UNESCAP, in Bangkok between 2009 and 21. During 2002 and 9, Dr. Kumar served as the Director General of the Research and Information System for Developing Countries, a think tank of the Indian Ministry of External Affairs. He has also served as senior economist at UNU Intech, which is now known as UNU Merit, Maastricht, Netherlands, between 1993-98. Professor Kumar has served on the boards of the Exim Bank of India, the International Center for Trade and Sustainable Development, Geneva, and the South Asia Center for Policy Studies, Kathmandu. He has also served as a consultant to the World Bank, Asian Development Bank, Economic Research Institute of ASEAN and East Asia, a Commonwealth Secretariat, Commission on Intellectual Property Rights, and TAD, UNDP, and many such institutions. He obtained his PhD from the Delhi School of Economics. Dr. Kumar is the recipient of the Exim Bank First International Trade Research Award in 1990 and Global Development Network's Research Medals awarded by the World Bank and the Japanese government in Tokyo in 2000, and the Distinguished Alumnus Award from Delhi School of Economics in 23. Dr. Kumar has researched extensively on international aspects of economic development, resulting in publication of 20 books and over 120 peer-reviewed papers, attracting more than 8,500 citations in Google Scholar. He regularly writes opinion pieces for mainstream media and tweets, and his area of research is very closely related to the kind of work that Professor Mohanan Pillai did during his time. So we got the right person today to deliver Professor Pillai Memorial Lecture, and we are very happy to have you here, and welcome, and please deliver your lecture. Thank you.
So on. Let me begin by thanking Professor Veeramani for a very generous introduction and for inviting me to deliver the second Pillai Memorial Lecture. And I must say that why I feel very privileged to deliver this lecture is because of the fact that I grew up reading the writings of Professors Subramaniam and Pillai. They were very often writing together. In fact, one of their books was Multinationals and Indian Exports, which actually influenced a lot of my thinking and writing. So I was very happy when Professor Veeramani invited me to do this. I spontaneously told him that I would be more than happy to do this. So I'm here. So I see many friends in the audience. Professor Joseph is a very old friend. Professor Pushpangadan, I have grown reading your writings, and my own colleagues and many familiar faces. But above all, Mrs. Subramaniam and members of the family of Professor Mohan Pillai, and I have met him several times in different occasions and always enjoyed talking to him. So I decided to speak or devote this lecture to the theme which was very close to the heart of Professor Mohanan Pillai, multinational companies doing or not doing exports. So I thought there could not be a better way to celebrate his life and works. And so I will go over it very quickly, and then we can have an open discussion. So, yeah. Setting the context. So first two slides are basically about why we think export competitiveness matters. So if we look at India's export performance over the past few decades, in this figure, the red line at the bottom is basically our trade balance of trade. And as you can see, it is going deeper and deeper in red. So currently, we are running a trade deficit of $330 billion per year, which is like 9% of our GDP. And normally speaking, it is not sustainable. Fortunately for us, the surplus we earn in services and invisibles is helping to mitigate part of it, which leaves the current account deficit, which is of very manageable proportions. However, off and on, it gets out of hand when there is a problem like the one we are facing today, that because of this Hormuz crisis, the Gulf War, the oil prices have shot up to the roof, and we are facing the pressure on rupee, the balance of payment issues, and all kinds of issues. So the point is that we need to be exporting more than we do and have a more comfortable balance of trade situation, not to rely on services. And mind you, there was a time when trade in services were expanding in a very robust manner, 15, 20% per year. Now that growth rate has tapered down. And with AI, we do not know whether services exports will be growing at all. They may come down. So this comfort of having services to meet your balance of trade obligations is not going to be ever there forever, and we need to prepare for those times when we will not have that comfort. So export competitiveness needs to be strengthened. There is a biggest challenge. It is not sustainable the way we are going on now. Now, looking around the world, manufactured exports expansion has been the main driver or engine of growth for East Asian economies. Forget Japan and Korea, they were, of course. But China, Vietnam, in our neighborhood, their main source or main driver or engine of their growth has been expanding manufactured exports, so much so that China became the global factory, the manufacturing hub of the world by just expanding, exporting, and all that. So we need to look at those stories of success and draw some inspirations. The other thing is, now, right, that we need to expand exports and export competitiveness, but how does GVC and MNEs or multinational companies come into the picture? So first of all, the gains from trade or globalization, global economic integration, have been highly asymmetric. China has been the biggest beneficiary. As I was saying, it has become the global manufacturing hub. So you see this line on the figure, the red line, which is expanding like that, is China. China's share in global exports has expanded from 1.79% to 14.3% just over 30 years period, 1990 to 2022. India also has expanded, but very modestly compared to China. So the orange line, which is hardly separable from this, the bottom, is the India, share, India's share in global exports, which has increased from 0.5% in the 1990s to 1.81%. What is some online person perhaps is, yeah, you can mute. So, but then other regions, Latin America and Caribbean, modest increase like India. Sub-Saharan Africa has actually lost in the share of global exports. So what explains this variation across regions or countries in export performance? That some have gone from here to there, some have stayed, like this, some have actually gone down. It's about their ability to harness or leverage the GVCs, GVC integration. So if you are hooked up with the bandwagon, you grow with them. They are expanding, they were expanding, and so this is where the GVCs come into picture. And a very substantial proportion of global trade is now, is connected or linked with GVCs. So between 46% to 70%, depending upon how do you measure GVCs. And I'm sure Professor Veeramani, is one of the leading scholars on GVCs, so you must be all very familiar with the GVCs literature. And GVCs themselves are linked with global production networks of MNCs, MNEs or MNCs or multinationals. So that is how the context is set. You need to expand manufactured exports. Manufactured exports need to be, they are linked with the GVCs very substantially, and GVCs are nothing but production networks of multinational companies. So that's how multinational companies and their export performance we need to look at. Now in this table, I have put some numbers. So how much of the exports of different countries have been accounted for by multinational companies? So in China, the proportion used to be 55 to 60% in the previous decade. Now, because they have acquired many of those multinational company subsidiaries themselves, and they have expanded the global footprints of their own companies, it has come down to nearly 30%. In Thailand, it is still over 70%. In Malaysia, between 60 to 70%. And in the second row, you see that in Thailand, 90%, more than 90% in electronics and automotives in Thailand, and over 90% in electricals and electronics in Malaysia. So very substantial proportion of their exports have come from or have been driven by multinational companies. So this is what can happen. In India, the numbers are very fuzzy, very difficult to get. But I was looking at this RBI census of foreign subsidiaries and all that. On that basis, one gets an idea of 18% of India's manufactured exports are accounted for by foreign subsidiaries. Now, you would say the subsidiaries are only majority owned by, there are minority owned foreign companies as well. So, my hunch is that in India, their share would be no more than a quarter, 25% of the total exports, and that's only now, earlier much lower. But you see that the biggest success story of India in the past few years has been the growing or expanding exports of mobile phones by both Apple and Samsung. They are both multinational companies. And so this is, making a lot of difference. And in next few years, I will not be surprised if Indian numbers or Indian share of multinational companies in India's exports also begin to look like more impressive, maybe not like Thailand or Malaysia or China, but somewhere in between. So in that context, I want to share with you some review of theory, evidence, and some policy lessons to draw from this literature. Now, how do multinational companies affect host country exports? So literature has identified two routes or two channels. One is an indirect effect, and the other is direct effect. So indirect effect is basically learning from what foreign companies do. So for instance, Bangladesh, which has become a major player in garment industry, second only to China, how did it become? It became by learning from multinational companies. So in 1970s, when Korea, which was that time a major exporter of garments, began to face the problem of rising wages, losing GSP quotas, and other issues. So they were looking around for a country where they could locate some of their garment manufacturing. And they found Bangladesh, a country which had just come out of independence. It became independent country. Wages dirt low, not much of an activity and all. They thought this is the country we should be in. So they built a factory, a garment factory, producing millions of pieces, huge factory. It was called Daewoo. Daewoo is a Korean company with some local group called Desh Garment, Bangladesh Desh Garments. And so that factory started the very first venture in garment manufacturing in Bangladesh. Then another company came. So there were a couple of Korean joint ventures. But then locals, after a few years, they realized that this is a very lucrative business. You stitch clothes with low cost labor. They have these duty-free, quota-free access as LDC, each developed country. So lot of local companies emulated. They hired the managers who worked with Desh Garment and set up their factories. So this export of garment culture, which was started by a couple of Korean companies, became a national trend. And now 80% of export earnings of Bangladesh come from one single activity, which is garments. So this is indirectly knowledge spillovers from foreign companies can play a big role. So this is one type. The second is export platform production by multinational companies in the host country, like Desh Garment. The direct effect of Desh Garments or Daewoo was, this is the export platform production. A number of theories in economics have actually talked about this. This could be. So there is a product life cycle theory of Vernon, which came in 1960s. And, so the product grows in maturity. Initially, it is produced in developed countries, but as it becomes a very mature product, they want to bring down the cost, so they shift the production to developing countries. Flying geese theory has been used to explain how the production moved from Japan to Korea to first-tier NICs like Hong Kong, Taiwan, and all, and then second-tier NICs like China, Vietnam, and all that. But but then it has not moved beyond China so far. Then eclectic theory of firms, internationalization of firms by John Dunning and many others were contributors. So they were able to identify some companies which will be setting up market-seeking FDI, some will be setting up the efficiency-seeking FDI, which is to exploit the advantages of other countries like cheap labor, natural resources, and all that. So that could be one way of. Then there were some material, some of it I was involved in doing that the export-oriented production can also be of two types. One of exporting back to the home countries, and one producing for the global markets, the third country oriented FDI. I'll talk about it in a minute, a little bit more. Then GVC theory, which came up in the middle of the first decade of this century. Basically, Gary Garafi has been behind a lot of literature on that, and it explains how production is fragmented across different countries to maximize efficiency, and it has been facilitated by advances or developments in the logistics sector, the containerization, for instance, which containers move from ships, and then from ships to hinterland to trains and trucks, and just-in-time inventory systems were developed. So all of this has, facilitated the GVC or fragmentation or fragmented production. Then Professor Veeramani has been writing a lot on this in India's context, for instance, and one of his major contribution is that a lot of people try to throw cold water on India's efforts to build the mobile phone industry, and so they say the value addition is very little. What is the value addition? Well, his contribution is that you should be concerned about overall value added generated in the country. So if scales are very large, it doesn't matter if value added per unit is very small, but overall you are reaping a big harvest. So for instance, phone manufacturing in India is employing 16 lakh people. It's not a small joke to create jobs for 16 lakh people, maybe more, but 16 lakh directly, I think, yeah. So do we want these jobs or we don't want these jobs, So to me, for a country of India's size and population passing through a demographic gift phase when average or median age of Indians is only 27 years, and we will be in gift phase for next 2 decades, finding decent jobs for youthful nation or our youth, there can't be a bigger challenge than that. So if some activity is creating value addition and jobs, why not? And also women, mostly workers employed in this activity are women workers. So now just a little word about the two types of export-oriented FDI, which I try to argue and find evidence about. So the home market-oriented production was basically the Japanese type of, shifting production to some country and exporting, or importing back. So this is a backyard effect. So the geographical proximity, cultural proximity, and spatial relationship between home market and the host, like an FTA, would be very important for this. Openness of trade may favor location, and export processing zones have been very critical to attract this kind of processing for back to the home country. And Japan, when the labor costs became very high, it's a labor scarce economy, so they practiced a lot of this labor intensive production was shifted, and they started to import back. Third country oriented production is more like the GVC type of. This is scattered across the world, and it results from efficiency seeking restructuring within multinational companies, which assign a product or process mandate to their subsidiaries that you do only this for the rest of the world, or you do this process for the rest of the world, and this is encouraged by liberalization of FDI or economies across the world, and also regional economic integration. So participation in larger customs unions or larger FTAs, regional FTAs for instance, helps. The preferential access to major markets or trading blocks also helps. The quality of economic and industrial infrastructure may also be important, maybe more important than the cheap labor. Cheap labor is important for the first type, a home market. So overall efficiency is important. So for that, openness to trade may be an advantage. You should be able to import any raw materials, intermediates quickly, and export processed stuff back. So this hypothesis, the trade-offs between determinants of FDI per se and its technology intensity, its depth, and export orientation, that too is split into two types of it. So I tested them in a 4-dimensional data set which covered 73 host countries, 7 broad sectors, 3 points of time, and 2 home countries, 2 sources of FDI. One was US and one was Japan. This is the work I was doing at UNU INTAC or UNU Merit. It was a very large project. We built a database called Globe TED, and that was used to test these hypotheses. So structural, geopolitical, and policy variables were all covered, and we used the benchmark surveys of United States Department of Commerce and similar surveys conducted by METI of Japan. So what comes out? I mean, not to bore you with a lot of results and all that, but just big picture takeaways. The importance of gravitational, because it was done in the framework of a gravity model. Gravity model is nothing but demand factors, the pull factors, explain FDI inflows, and the geographical and cultural proximity also come up very strongly. But there are important trade-offs which we need to recognize between the breadth and depth of FDI. So FDI will be attracted by some factors, but the depth, how much of value addition they will generate in your country is depending upon some other factors. So like trade openness works, in both ways. It makes a country attractive for attracting FDI, but the depth is inversely related to the trade openness. Performance requirements. A country imposing certain performance requires that local content requirements or export processing requirements. They also affect. And the investment and tax incentives. They appear to be quite significant. And we will come and relate it to what happened in China's case. So role of agglomeration economies and created assets. So if you are doing some R&D, you have built some strengths, that helps to attract more FDI and of better type. So, and these simulations also distinguish between different nature of the two types of export-oriented production, which I was trying to argue. Preferential access to markets turns up as a very important factor for export-oriented FDI of both types. So, this again relates to some of the policy lessons that we will have towards the end. And in particular, the investment incentives and tax breaks for third country oriented FDI are very clearly distinguished. So, the one sentence takeaway from all that analysis is that export platform FDI is a very special type of FDI. It's not, if you think that I am attracting all kinds of FDI, so export oriented will also come automatically, it will not happen. You make your country open to FDI, all kinds of them will come, but the export oriented FDI requires a very specific targeting, and there is a greater competition for it. Now, there is another stream of literature which is about determinants of export performance of Indian firms and what role does FDI or multinational companies play. And the first one here is obviously the one by Professor K.K. Subramaniam and Mohanan Pillai. It was published, it was a book published in 1979. And it showed that multinational companies in India were actually having poorer export record than their local counterparts. And they also imposed, restrictions, export restrictions on their collaborators in India. So actually they were not really helping the country about with export performance. Then we followed it up in 1993. There is a paper in JDS. Me and Siddharthan, Professor Siddharthan of Institute of Economic Growth. So we did an exercise with 406 companies in 13 manufacturing sectors. Again, FDI variable was not significant. So, but these were all, pre-reformed data. Then Aradhana Agarwal in 2001 came up with this foreign ownership dummy showing a mildly positive effect on export performance, and her data was post-reform period, so maybe reforms started to show some effect. Then Kumar and Pradhan, my work with Pradhan, and this is published in a book co-edited with Professor Joseph. So this, this book had a combination of some, quantitative, chapters and some, industry studies. So there were 5 of them. So we tried to test at the field level the results obtained from the econometric analysis. And there, interestingly, in a sample of 4,273 manufacturing companies, a panel data set for 11-12 years, FDI and outward FDI both turned out to be with the very significant positive effect. So, and then again the mixed picture continued. This Ghosh and Sinaroy, Saika Sinaroy, 2018 paper, they concluded FDI doesn't matter for export performance of the firm. Then Sahu and Dash, 2022, very recent paper, but in a cross-country framework. Again, no, they came up with the FDI matters for exports in a cross-country setup. Then very recently at ISID, we have been doing some work on this FDI and exports, and initial cut or initial results were reported in India Industrial Development Report, which is a flagship of ISID, published last year, and it's available on our website if you wish to look at. So we had a very large sample of 11,450 manufacturing firms across 23 manufacturing sectors and 12 years of panel data set. And here again, FDI and OFDI both come up with a very strong positive effect. So if you try to sum this up, what is the takeaway? That in the early part of our development, when we were a closed economy, multinational companies were coming to India to tap the domestic market. They were not looking at India at all as a possibility for exporting from India, because it was a closed economy. You want to import some components or raw materials, you can't do it easily, or you have to pay very high tariffs and all. But after reforms, they have started to look at India not only as the domestic market, which is very attractive, of course, but also to some exports from India. So reforms have, seemingly reforms have brought a change. The other dimension, as I said, this FDI and OFDI both have come out positive. So outward FDI by Indian companies, that also is an FDI. So we have also looked at that, and emergence of Indian companies as a significant outward investors, especially through acquisition of very large companies in the Western world, has become a very visible phenomena, and a lot of people have written about it. So currently, our companies have been investing abroad on a per year basis about $55 billion, including guarantees. And last 25 years, $797 billion. So average comes to $32 billion per year, which is not a small thing. It's slightly lower than FDI inflows to India. So India has emerged as a very significant outward investor. And the turnaround came at the turn of the century, when Tata Tea, which owned several tea bagans, as they say, and they were exporting tea from India in big tea chests, in a raw form as a commodity, which is commodity, is auctioned at London Tea Exchange, and we are fetching something. Hardly any value addition on a commodity which was grown in the fields. But in 2000, they paid some $800 million to buy what was Tetley Brands in UK, which was a tea processing company. So buy the tea in bulk or loose and convert it into tea bags, which you dip in your cup, which is a huge difference between the commodity type of tea, which you buy by tons or quintals, and the tea which comes in your tea bags, a 2-gram tea bag costing 5 rupees, 10 rupees, and all that. So the huge value addition. So the branding and marketing and then making of this tea blends in the tea bags. So Tata combined their orchards or bagans with the brands and making of this tea bags. The whole value chain was in the same company, And it is also interesting that Tata Tea was a much smaller company in terms of market size or market value than the Tetley brands, which operated across the world and all that. So how did they do that? The Tatas have a strong, sort of credentials with the financial system. So they were able to engage in what is called this term leverage buyouts. So you buy the company, mortgage the shares of that bought our company, and pay from the loans. So you can buy a much bigger company without actually bringing capital from the country. So this is what the model was practiced, and it became a very interesting aspect of India's global globalization of Indian companies. So in a paper in 2008, I identified 3 phases of evolution of Indian outward FDI. The first phase was in the times when India was a closed economy. So very small ventures like Usha fence, assembling Usha fence in Sri Lanka. It's a very small operation just to take your scale down technology to other countries where there may be demand. The second phase came in 1990s after the liberalization, that some companies which were in the export markets needed to support their exporting operations by having a global presence or a local presence there. So pharmaceutical companies and then the software companies began to set up offices in different countries. And again, this was a moderate or modest kind of operation. But the big phase, big turnaround came after this 2000, when this Tata Tea demonstrated that we can do much larger things by leveraged buyouts. And so Indian companies started to engage in efficiency-seeking FDI largely, and big acquisitions have taken place, like Tata Steel taking over British Steel, Tata Motors taking over Jaguar and Land Rover, Hindalco Industries, which makes aluminium, took over this Novelis in United States. And so a lot of these some companies went out for acquiring mineral deposits, mineral endowments, like Adani's in Australia or Tata's in South African iron ore mining and all that. So OFDI as a strategy to move up the value chain in international markets is also a very important thing we should not overlook. Multinationals from the West coming and helping us is one, but Indian companies going out and building a global footprint is also another. So combining the low and back ends with access to global brands, value-added products, marketing networks, and customers through acquisitions, so it can be helpful in helping Indian companies move up the value chain quickly, because building a global brand is a very slow process. It doesn't happen easily, and it requires a lot of resources and patience. So if you can acquire a already recognized brand, it is you can jump start or do that very quickly. So so I have given these examples I was just talking about, but Chinese have really perfected this skill of acquiring global brands and global footprints. Lenovo is a very well-known brand in the laptops market today. But do you remember the origins of that? Only 10 or 15 years ago, there used to be an IBM product called ThinkPads, which was the leader of this industry, laptop industry. ThinkPad was sold as ThinkPad. People bought ThinkPads giving a premium of 20, 30, 40%. Think Center, ThinkPad. So there was a whole range of these products. Lenovo, which was a small company at that time, former state-owned enterprise in China, like many others have been, privatized and to become global. They bought IBM's ThinkPad division for just $2 billion. That catapulted this small Lenovo company into a global player with a globally recognized brand name, and now it is a market leader, So all the technology, all the brand name, and gradually they were smart enough to build their Lenovo brand. So first it was Lenovo ThinkPad, then the ThinkPad gradually diminished as people started to remember Lenovo, because for every time they use ThinkPad brand name, they have to pay some royalty to IBM. So they didn't want to carry it for, but they used it as long as it was needed, then they quietly, So this is the kind of strategy company after company you go to, the ones which have become global, higher, these refrigerators, air conditioners, higher brand. They acquired GE Electric and and Carrier Aircon, and they became a global brand. So Geely acquired Volvo. So I have a list of maybe 100 companies, 100 Chinese, which are top brands. They were all doing that or achieving that through acquisitions of Western companies, and they just catapulted themselves, from a small Chinese company to a global company. So implications for Indian economy, whether it improves competitiveness, the empirical evidence which I earlier shared, yes, it does. Whether it crowds out domestic investment, because we are in the market for capital investment, whether investing out is cutting into our economy. I think no. It is a win-win, because this is how you expand your global reach, and by investing a small seed capital, you actually grow a lot of exports of knockdown products which go out from India, like many of these operations of Mahindra and Tatas. They are assembling their vehicles in different places. So they take these knockdown kits of these vehicles and just assemble them. They gives them the comfort to the foreign governments that they are doing it here. But actually they are exporting from India. And so there is nothing wrong. So it brings more opportunities. But there is a challenge of managing or integrating across cultures. It's not easy to absorb a culture of a foreign country, a foreign company. So I'm told that Jaguar Land Rover, some people who are very deeply into automobile industry, they tell me that Jaguar Land Rover was a very top brand, it's a luxury car maker. Tata Motors did take it over. They also benefited from some technology transfer. They helped, Jaguar Land Rover engineers helped, shape up the portfolio of cars of Tata Motors. It has benefited. But they have not been able to fully integrate Jaguar Land Rover with themselves because of very different cultures, that are there. So there are those issues. Innovative activity is very critical to sustain outward investment, outward expansion. If we want to, if we are serious, we should also pay attention to innovation. And supporting policy regime also is important. All countries in the world support their companies to go abroad, and China has been the master of this game. Now, the other aspect of this globalization and exports I want to talk about, and that's connected with multinationals, is India's emergence as a global hub of GCCs. Global capability centers are called GCCs. You hear a lot about them, and they are all MNCs, they're subsidiaries of multinational companies. So they represent the globalized R&D in India, and India has become actually a very important player. 50% of all GCCs in the world are in India. So if any multinational company globalizes its R&D, they think of India before any other country. So that is the importance. And they, the abundance of low-cost trained manpower is a major pull, but and that is why it is clustered around, some cities like Bangalore, Hyderabad, Pune, and also maybe cities like Trivandrum, which have very high concentration of higher educational and scientific institutions. And opportunities, what it has created is again decent employment opportunities for Indian youth. So 1.86 million was a number thrown at me last year by some of the companies which look into this. R&D exports it generates are of the order of $40 billion per year. It also explains the rising number of patent filings from India. So you see, the patents filed have suddenly shot up in last few years. But the challenge is that they remain like enclaves. They remain like, isolated from rest of the R&D institutions in India, and so we are able to absorb very little of the knowledge they are generating. So this is one challenge we have to deal with. So now coming to the last part of this talk, drawing some policy lessons from all of this. Now, we are passing through a very difficult, globally, very difficult context, a very difficult environment. But even before that, if you look at the trade structure of India and the trade policy, which means FTAs with which countries we are signing FTAs, there is a clear divergence. So the divergence in geography of India's trade is that rising importance of East Asian countries, Japan, Korea, ASEAN, and China as sources of imports. So you look at the the chart where the sources and the destinations of India's trade are given. So the bulk of the imports are coming from these countries, and the exports are mostly destined to Western countries. The United States, which used to absorb 20% of India's exports, UK, EU, and some other European countries. But in our FTA policy, in our trade policy, we have somehow prioritized FTAs with the import sources, not the export destinations. So that divergence has been actually very troubling and very problematic for India, in the sense that we were running this increasingly widening trade deficit, as I was saying in the beginning. So we need to now, now the government has, in the last 1.5 years, has done very good work, in the sense that the FTAs, new FTAs have been signed with all the major markets of Indian products. So UK, EU, EFTA. So with the three agreements, we have preferential access to virtually entire European market. US is now in nobody's control, so we were wanting to have some kind of trade agreement with them. But with Mr. Trump, I think, as there is a famous quote by Henry Kissinger, that it is dangerous to be friends of, it is dangerous to be enemies of United States, but it is fatal to be friends of United States, So either way you lose, you come close. And so we don't know really what is going on. And, Mr. Trump today, he has something, tomorrow another thing, you can't really. So we have to leave them alone for a while. And I think it is nearly 1.5 years gone of the 4-year presidency. So I think the usual refrain is the wait for some more time, and hopefully change will come. And so, but with rest of the markets, so whether it is European Union countries or Australia, UAE, and all of these countries we have now functioning FTAs. Some of them will be becoming operationalized in next year or this year or something. We should really make use of them to deepen our export markets in these countries, especially of labor intensive goods. South-South trade is also another thing which we should pay attention to. As you see from the bottom chart, the South-South trade has been expanding by far the fastest growth, and we need to look at where we can deepen our engagement. And for that, better coordination between India's economic assistance, which is very substantial actually by now, and the LCs and export promotion. So they should go hand in hand. So Western countries have been doing, they're twisting your arms, giving you some dollars as aid, and also making you import from them or do something. And managing a competitive exchange rate in real terms is very critical. Now India's rupee exchange rate has actually come under pressure. It is probably undervalued, but in the past, there have been episodes where India's rupee has been overvalued, which doesn't do any good for India's exports. Now, leveraging India's advantages for attracting export-oriented FDI or GVC-oriented FDI. As I said, this is a very special type of FDI. It's not that you have Invest India and so whatever FDI we get. No, so you have to go after them. And so specific proactive targeting of export-oriented FDI and GVC integration is a must. And there we should market our advantages better. So large and fast-growing domestic market, for instance, one very top-tier multinational executive or CEO has given an interview and said, India offers both scale and momentum. Momentum meaning dynamism, which is a rare combination today. Look around the world, which country has this kind of scale and dynamism? None. So China, which used to be having like this kind of advantage, has now come down in terms of growth rates, 4 or 5% type of growth rate. We are also a demographic sweet spot, and you look at and this figure, all OECD countries are in the working age population, which is in the demographic burden phase, where the proportion of earners is lower than the proportion of dependent population. But in India's case, and only a few countries, so you look at from Japan to Korea to China to Europe to United States, all of these countries are graying or aging populations, and only India and a few other South Asian countries and African countries have that gift phase. We should leverage and talk about it. ICT software and chip design capability is very globally recognized of the capability of India. So this should also be leveraged for digital revolution. And then this China plus one type of restructuring, there was a time when it was upset because of the Trump tariffs and reciprocal tariffs and all that, and we not having any FTAs with the major countries. Now we have the major, the FTAs with major countries or markets of the goods. So we should now get into the game again and try to attract this China plus one type of global supply chain restructuring investment. US will continue to remain uncertain, but at least entire European market becomes open to us, and also Japan, Korea, Taiwan, Australia and ASEAN, UAE and GCC. So all of these countries can be targeted. Then the industrial policy. I think if one single thing in this talk you want to take away, it is the relevance of industrial policy, and China is the biggest role model for this. I want to just share with you the fact that China, is today, of course, a global factory driven by FDI and GVC integration. It was not an automatic process. It was a result of a lot of strategic and targeted interventions, which are called industrial policy tools over the years, comprising, for instance, huge subsidies, tax incentives, subsidized credit and land, among others. We used to always talk about it, but there was no figure. You did not have a figure or a number. What is the proportion of the subsidization that China does? Today there is. Today there is this evidence produced by no other but IMF itself. So IMF economists have turned up with the paper which shows that the red part of this bar is cash handouts. This is 2%. It used to be 3% earlier of GDP. So this is GDP. Then the tax breaks, another 1.5% of GDP, and then land purchases, subsidized credit. So 4.5% of GDP they hand over to industry. Now the catch is manufacturing value added is only 1/3 of total GDP. So if they are giving 5% or nearly 5% of GDP to industry, and industry share in their GDP is only 1/3, so multiply it by 3 times. So 5 into 3, 15% of manufacturing value added is given away to companies as a subsidy. This is the extent. How can anyone on the earth compete with a company or a product which is subsidized by 15% by the government, on a systematic basis? So this is the source of their so-called competitiveness. This is not competitiveness, it is artificially done by them. Now, preferential treatment was given to FDI for very long time in taxation policy, so much so that even domestic investments registered through Hong Kong as foreign investment. So there was a round tripping. There was a lot of evidence around. They abandoned this policy in just 10 years ago when they became already very big players. So they thought it's not needed. But for a very long time, they had one type of tax policy for FDI, another for local firms. And local firms were charged higher tax than the foreign firms. Then, in lieu of these incentives and tax breaks and preferential treatment, they of course impose certain performance requirements, like joint venture requirements. They would ask you to export in return for giving access to the domestic market. So they of course exploited and they took full advantage of what they were giving to multinational companies. Side by side, they also paid heavy emphasis on absorbing know-how brought in by multinational companies, and R&D investments were pumped. So now they spend nearly 3% of GDP on R&D, and they have become leaders in many fields, and technologically. So and then they started building national, champions, including through acquisitions. I gave the example of Lenovo just as an example. And then this new evidence has come up. I mean, I had quoted earlier my own study which showed tax and investment incentives do show up significant. But there is a very new paper on China, Harrison, you would be familiar with her work, along with two co-authors. that tax breaks and subsidies have drawn FDI into strategic industries that spawn significant productivity spillovers for the Chinese industries, corroborating earlier studies. So, and in India, this recent success of PLI for expanding mobile phone exports is also an example that PLI or incentives, investment incentives and tax breaks can work. Now, a lot of people are criticizing this. Why are we subsidizing Apple? Many very influential senior people are concerned. The idea is that the case for industrial policy arises because there are market failures. The private entrepreneur is not able to reap all the returns, all the gains that accrue to the economy of his or her investment. So government, has to subsidize the investors for some time and then reap the rewards of, so once you become established player in a certain industry, then you reap the harvest not only of job creation, but also of, expanding output and taxes on that and all. So this is one. Second thing is that in a world, we don't live in a world which is only India. We live in a world where, different countries, different governments are giving handouts to attract investments. So United States, of all the countries, the biggest champion of free markets in the world until recently, what are they doing? In 2022, Mr. Biden is not, not talking of Trump. Trump, you can just put him aside. Mr. Biden administration in 2022 put on the table $1.2 trillion to be given away to companies like Intel and AMD and whatnot under the three acts. The three acts were CHIPS and Science Act, the Infrastructure and Wages Act, and Inflation Reduction Act. So I counted how much money was allocated under these, $1.2 trillion, which is like 5% of their GDP. Their GDP of United States is about $20 trillion. So they were, so you live in a world where companies are being subsidized by other countries. So if you don't want to give, don't give, no problem. They will go to another country. They will go to Vietnam, they will go to China, they will go to United States. So we will lose. This is the point. So we want to give. Now, first time a government has evolved a incentive scheme which is limited in duration, so 4 to 6 years, and it is post facto. So you are not given anything beforehand. When you deliver, you collect your incentive. So this is the chances of failure. So for instance, people say that PLI is only success in telecom, but not in others. So others, okay, nobody picked up the money, we haven't lost that money. Money is not gone anywhere. Money will go out of government's treasury only if they deliver, So it is, so the chances of loss is very minimized. So I think the justification of these industrial policy tools is firstly the market failures, for which the industrial policy was justified in the first place, and the other is a competition, global competition for investments. And all countries are now doing that, even those which had gone out of this, which had become free market traders like United States and EU, they are the biggest users of these policies these days. Critical to augment industrial activity is, of course, I mean, it goes without saying that we want to really become an exporting country, build our competitiveness in exports. We cannot do without achieving a significant amount of R&D activity going in the industrial sector. Professor Veeramani, how much time, or I have already run out of my time? So, okay, I have 5 minutes. I'll wind it up. Yeah. So R&D activity, basically, India has moved up in certain indicators. For instance, in the global innovation rankings, we have moved up from 81 rank to 38th rank in the last year. Robust growth in patenting activity, which earlier I was showing, which may be a result of GCCs patenting a lot. GCC coming is also a kind of vote of confidence in India's R&D capability. Yet this 0.7% of GDP that we spend on R&D is very low. Now, in the IIDR, which I referred to earlier, India Industrial Development Report, we questioned this 0.7% figure, and we thought it was not measuring all of the R&D activity. So it was an underestimate. But what would be our estimate? So we came up with some number which was 1.25%, which is more respectable than 0.7%, is still much below the global average of 2%. So we need to bring it up, and the other problem is that the bulk of this R&D activity in India is spent in government labs, not in industry, where it could directly feed into export competitiveness. So this is something which we need to really pay attention to, and there have been recent government announcements of the ANRF, the Anusandhan National Research Foundation, and then the 100,000 crore RDI scheme, which will be disbursing cheap loans, 0% kind of loans to industry for R&D. I think these are all good initiatives, but my feeling is that very few companies may turn up to borrow for doing an uncertain activity like R&D. R&D should be left to themselves. And one of the ways we were promoting it in the past was by giving the weighted deductions, of 200%. So if you invest in R&D 100 rupees, you get a weight deduction in tax of 200%. So that way it was incentivized and left. The decision making was simpler. It was left to the company to decide, and maybe the time has come to restore that. And also for MSME type of R&D activity, the petty patents could be very useful mechanisms. So maybe we can think about. And finally, to enhance the local spillovers from GCCs. The GCCs are doing a lot of research in India, but what they are doing, nobody knows. And so we need to find a way to absorb the spillovers of their activity. And one of the ways to do that is to incentivize the workers or the scientists working in the GCCs to give them funding to start their own ventures. So they bring the knowledge acquired in these companies, and the country benefits from that. And finally, I think, yes, this is just the last but one slide, building national champions. So going back to what I was saying earlier, that we will not be strong in export markets, and we will not be able to absorb full value addition unless we have our own national champions doing this for us. So like building a Lenovo out of nothing. That is the kind of approach we need to have, a strategic approach we need to have. So encouraging larger Indian enterprises in the areas of their strength. Some of the areas where we have become stronger, like pharmaceuticals or auto or software, encouraging them to become global players, not an Indian player doing some exports and all that, but a global company like Pfizer or Glaxo and all that, which is renowned all over the world. And for that, if you need to take over some of the brands, by all means, we should be supporting them in that process. So leverage buyouts provide an important means. And Indian companies, we have been looking at them, and Bina has also worked on that. The companies have cleaned up their balance sheets. Indian companies have cleaned up their balance sheets over the past 3-4 years. They have not been investing much, but they have deleveraged themselves. So they have, retired the debt they had taken. So they are in a very healthy financial situation to be able to be engaging in outward investments. And in particular, I am very much concerned about why we are not doing these kind of global footprints acquisition in labor-intensive and skill-intensive industries like garment and textiles. So garment and textile, probably all of you know this story, that a shirt which sells for $40 in global markets goes from India or Bangladesh for just $2. So $38 per unit are earned by the companies which brand and market them, and the poor people who are, stitching them to the perfection only get $2, including the cost of raw materials. So value addition happens in the branding and distribution, and that is where we need to step up our game. And any big country has a national champion identified with it. So H&M of Sweden, M&S, of UK, Adidas with Germany, Zara of Spain, Benetton of Italy, Uniqlo of Japan, and Shein. The latest edition is China starting its own garment chain, Shein. Some of India's largest business houses like Tata's, Reliance, Birla's are all there in garment industry. Why can't they think of acquiring one of these brands? So, and some of these are, I have checked up their market valuation of these M&S and H&M type of $4, $5, $6 billion. It's not a big deal for them to acquire some of these brands. Benetton, for instance, is in liquidation. They are in insolvency. So it may be available for cheap. So how can we entice these Indian companies to take over some of these brands and become global overnight? So finally, just to sum up, I think strengthening export competitiveness is an important challenge for India. We can't live on this 9% of annual trade deficit run year after year. Export-oriented FDI and GVC integration have been important drivers for East Asian countries, and India has had limited success, if at all, so far. Export-oriented FDI is determined by different factors and it needs specific proactive targeting. Reforms may have helped FDI to play a greater role in India's exports, but we need to do much more. And OFDI has emerged as an important strategy for firms to move up the value chain and acquire global footprints. And MNCs or MNEs can also play an important role in export of, they are playing an important role of export of R&D services through GCCs. So what are the policy lessons? Which I just listed in last 3-4 slides. Again, just recapitulating, leveraging new FTAs with key markets to diversify our manufactured exports, leveraging India's advantages for attracting export-oriented FDI in the context of supply chain restructuring, investment incentives and other industrial policy tools play an important role in attracting export-oriented FDI, and it is very critical to augment R&D activity and enhance and absorb knowledge spillovers from GCCs, and finally to build national champions with global footprints. So that is what I wanted to share. Thank you very much. Thank you.
Thank you, Professor Nagesh Kumar. That is really a tribute to Professor Mohanan Pillai and also Professor Subramaniam. You know, if they were here, they would have been really thrilled and would have asked a number of questions, including very provocative questions to you. So I could really imagine how they would have reacted to the lecture.
Sure,
so
would have been listening to somewhere
yes. Yes. So, it's a 360-degree view of, India's global integration aspects, various dimensions of global aspects, including trade, starting with the trade, saying that, there is a need for expanding India's manufactured exports, and the way forward is to integrate into GVC, and for which you need multinational companies, not just inward investment, but also outward FDI. Both have been touched upon. And then, two types of FDI, domestic market seeking and export oriented. And the lecture covered theories as well as empirical evidence on various aspects, and also global capability center, a new form of global integration for India that has also been touched. So it covered all related issues, and thank you so much for that, and also very clear policy lessons on how to navigate in this current scenario, what are the policy options available for the government, including creation of national champions, diversification of markets beyond the US, industrial policy measures, free trade agreements, and all such things. So I think in this audience too, there is a lot of interest on these issues, and some students are working on it, and it would be faculty members also working on it, on similar issues, and I'm sure there would be questions, and I will just make few comments and then open it up for a discussion. So one important takeaway from your lecture is that since China is a kind of concentrating a lot of manufacturing capacity there, and it is generally very difficult to compete with them, especially given the fact that the numbers that you have shown in terms of the subsidies that they are giving to their industry. So situation is that India can't compete so much with China in this kind of situation. And you have also mentioned that this industrial policy is being practiced everywhere, including China and also in the US. And India, being a poor country, can't provide that much subsidy, competing with China and US. So giving subsidy and then competing with them may not be a practical thing to do for a poor country like India, because we have many other priorities, like taking care of poverty, all other welfare issues, all other things. So spending money for industry means less money for other purposes. So that would be a problem. So given that as a kind of reality that we are facing, then what is the way out? So if I may suggest that the only way out in this case is that now we are seeing it because countries are violating rule-based system. Right? The WTO has become weakened. The multilateral system is not functioning. US is particularly responsible for that. The appellate body is dysfunctional. So in this case, there is a role for countries like India now to strengthen the multilateral system. It is true that for multilateral system, US play an important role, but then if you look at the US share in global trade, it is just 15%. The remaining 85% of global trade is happening outside the United States. So why can't the rest of the world come together and strengthen the multilateral system so that a rule-based system prevails. That's the only best bet for a country like India to address this problem, rather than competing with China and the US in industrial policy subsidies kind of thing. So this is one suggestion that I thought. And then another one I thought is that, you have covered very well about important aspects of India's global integration, outward FDI, inward FDI, global capability centers. But I think another emerging and important, relatively less exploited opportunities for India, again with a global connection, one is the remittance. Kerala is a big beneficiary of that, but even India is now becoming an important beneficiary. There is a lot of remittance flows that is coming, and particularly because advanced countries are aging, there is an opportunity for us to concentrate our investment and attention in care economy related activities, and then because they need labor, particularly in the care sector. So that is another more area for us to do this. Then tourism, we are not exploiting enough. Our tourism receipts as a share of the global tourism receipt is just 1.5% or something, but we have a huge potential there. Then other areas like medical tourism and all those are other areas that I think we can focus. So these are my initial kind of comments, and with this I would now open it up for...
You want me to respond to you?
Yeah, you
we
can collect whatever way you want. Yes. Yes.
I think it was a wonderful preach. As Dr. rightly said, really enjoyed it, and many questions could have been raised. What Professor Veeramani raised, we are a poor country, how can we think in terms of 4%? 4% of the GDP is going there as industrial, this thing you rightly said, and in this country, overall share of all subsidies only 1.4% of the GDP. And I personally feel that I perfectly agree with all your arguments, because I have no quarrel over there. But final point which you Veeramani raised, I think, why can't India take a lead today? Because India, that's something which is excluding the US. But I think I'm not raising question, since you are in the Monetary Policy Committee, much of this problem which we diagnose in the area of trade, technology, FDI, industry, actual solution lies in public finance. We have a public finance where R&D is considered as a current expenditure. And we have a public finance which considers state investment should not be more than 3% of the GDP. We have an public finance which believes that any investment, if it can bring returns more than the rate of interest, can't be encouraged. That is the golden rule of public finance. I personally feel that quite a lot of problems lie there. We argue from here, unless it gets translated. You rightly argue for 200% R&D discount, which we had earlier. Now the point is, these things to get translated into policy, everything's a done. Everything's a done. We need to have a fiscal policy which is appropriate, a development-oriented fiscal policy rather than emulating the fiscal policy of other countries. That's one point which I said. That will happen if only with that we can globalize at our terms and out at our pace. I think I perfectly agree with all your this thing. It was indeed a nice journey. I must say that it's a wonderful journey. So thank you very much.
It was an excellent presentation. I really enjoyed some of the items you have presented. I was not able to follow because it's not my field of competence. But one thing I have noticed that, this competitiveness you have talked about, mentioned competitiveness, our exports. How does it compare with the other major players in the system. Indian, other players like US, China. I'm just talking about the market forces. Are we in the some advantage? Do we have an advantage in this? That would be ideal, to begin with, so that it is within our control. Okay. That's all.
Oh, thank you, sir. Sir, my question is, sir, is about the success you pointed out about the success of the pharmaceutical industry in the global value chain. My question is, like, the pharmaceutical is what we are following is like more predominant kind of like allopath kind of, but we have other alternative like Ayurveda. Is there any scope what in this global value chain, because this is coming from very different epidemiological point of view. So how is there any space to accommodate these alternative in this global value chain? Thank you.
Oh, okay. Let's collect.
Thank you, sir. Very insightful presentation. So I have a couple of questions since you have brought something Chinese success stories and Chinese experiences you have brought. See, countries like India, we have a large informal sector where MSMEs are dominant in the Indian industry, right? So when we see the Indian industry from the MSMEs and the informal economy angle, we will be rising with couple of questions when we'll see from the GVC perspective, right? So one is how far these MSMEs and informal sector is been plugged into the GVCs network, and does this, in the GVCs, are we really, because of this largely informal economy, are we, fixed with the low segment of the production activities or something like that we need to look into when we see from the informal economy angle. Similarly, when we see from the Chinese success story, I was always been thinking that, Chinese success story was not always, it's not just seen from the FDIs or large participation in the value chain participation, but also it is always complemented with the, significant local domestic production activities, right? And especially if you see from the example, if you see the Realme, which has really attracted the global market, it was actually a small MSMEs outputs, but it was largely facilitated by the Chinese, government market facilitation, right? So such kind of a encouragement to the local domestic, production activities would actually lead the value chain participation. That is what, I mean, I just want your comments on this, yeah.
Thank you very much for some very important and very penetrating questions. Now, coming to Professor Veeramani's thing, I think it is in an ideal world, of course, we should have a multilateral trading system, very well functioning multilateral trading system. So currently, of course, the way it is functioning and the latest reports I was reading on the way to Trivandrum, the ministerial in Cameroon has collapsed. No, like many other WTO ministerials. So basically the leaders of the world economy have lost interest in the multilateral trading system. They feel that they can benefit by practicing might is right. And, so, I was telling an American trade negotiator that when I was very deeply involved in trade negotiations in my time at RIS, we used to always go to Geneva and ask for special and differential treatment, that poorer countries get better treatment or non-reciprocity, that you give us some preferences, we don't have to match, and that becomes a special and differential treatment. Now, United States is asking for a special and differential treatment. In the kind of agreement that Mr. Trump was signing, that we will charge 18% tariff on your goods, you will have 0 on us. So, one-sided. So this is where we have reached. But your point about that whether a country like India can really engage in a competing with, giving subsidies to the extent that China or US are giving. No, obviously not. But we have some other advantages as well. So a package, of this, like Pillai, is a very small bit. It doesn't even add up to 1% of GDP, all of whatever has been given. So some rationally designed scheme which gives some incentives, some facilities, and combined with our other advantages like youthful workforce, which is also lower cost, and give them facilities, with the land, which they find it very difficult. So if we can, make a good package of incentives, because after all the other countries, China, because they have got such a huge concentration, companies are actually moving out. They want to move out of. So they are. So we have a little advantage at this stage, but some bit of icing on the cake kind of incentive, linked with some performance, which is like a production linked incentive, is linked with performance. So that's the one thing I like about, because there are a lot of incentives which were given in the earlier phase, which were all wasted because they collected the handouts and didn't deliver. So this kind of thing, small, modest handout, but for a limited period, to just allow them to have a breakthrough and then leave them alone. That kind of thing would be. But ideally, of course, multilateralism is the best bet for a country like India. But mind you, some countries know how to break the rules of multilateralism. The erosion of multilateralism started only in last 5, 6 years or 10 years, but China has been doing this subsidy game for a very long time. They know how to put it in a deceptive manner and go ahead. And US and all other developed countries have also used these performance requirements and all. They don't want us to use, but they have themselves done. So finding ways in the multilateral system are also not difficult, but important point was that there was a dispute settlement undertaking where you could bring cases against larger powers which you otherwise can't do. Even that is gone. So this in a way gives us some policy space also, that we can use some policies which may be otherwise not possible, may be challenged, but now because there is no dispute settlement effectively, we can use that for some time and get away. I think the other 2 points that you made, tourism and remittances economy, the aging manpower in the Western world, and that creating a lot of opportunities for India. And tourism, we are unfortunately not exploiting our potential. Both are very valid. I think we should invest in these. They have a lot of potential. And then country after country now, there was last week only, I heard somebody saying, in some CII meeting, that Germany, their companies are now hunting in India to recruit some fitters, then some, technicians and all, because they have no manpower to run their factories. So this opportunity is going to be very big for India. And we should prepare our, manpower or human resources to be available when whatever is needed. So AI will also create a lot of opportunities for India. And tourism, certainly, I think the kind of diversity and richness that we have, and also on top of that, educational and medical tourism, sky is the limit, and we should tap that. I think Professor Joseph's point about development-oriented fiscal policy I fully agree. This is very important, and R&D investment should be treated as an investment rather than a current expenditure. And for that, this weighted deduction certainly should be restored. I think your point about competitiveness, as long as we are not competitive, obviously we have no chance. That's true. But as what I was trying to argue is that some of these Chinese competitiveness, I mean, these business people say, I will buy wherever it is economical or which cheaper or competitive. But what I was trying to show is that this competitiveness is artificial. It is given, handout, given by government, and of course they have built scales, but scales over time we can also build. Scale gives them an advantage, and on top of that, this 15% government subsidies, that is building their competitiveness. So it's not all that they are Chinese, so they are smarter people, they make it everything better. No. And there are also still a lot of quality issues with Chinese goods, So their competitiveness, I don't buy this, that they are more competitive than us. They are made to look like more competitive, So that is... And then, yeah. So your point about Ayurveda and other, why can't we build GVCs in others? Very good point. We have this heritage, but are we really exploiting it? 3 years ago, I was on a trip to Sri Lanka, personal with family, just a tourism kind of thing. At the airport, we found a boutique, very nice boutique, selling some of these cosmetics made with Ayurveda and explaining, they had made a films about it, very nicely packaged like a Western company would do. And so they are targeting premium customers, very highly priced, but very nicely packed and demonstrated that this is the value we have added. So they are exploiting the Ayurveda heritage, of which probably went from India, or maybe partly they share it with India. We haven't built that kind of a brand, which is globally marketable and known. If we do that, that is a very important point.
They started making. So the alternative, the technological way of the thinking, it is the Ayurvedic, to cure any particular disease, there is something you have to work according to what the body needs. So there is a specificity, I'm asking, there is an alternative. All this are doing, the China is doing with the help of reverse engineering and all. But the alternative kind of framework we have, is there that is there any possibility?
No, yeah.
Universalizing in very different sense.
Yeah. Okay. No, got it. Yeah. Well, I'm not an expert of pharmaceuticals per se, but I'm sure there must be. It must be possible, and so talking to some pharma company experts would be giving you good answers. But my problem with this, Indian heritage, of lot of nutraceuticals, pharmaceuticals, lot of cosmetics and all that, we are not fully tapping it. We can make a very big brand out of it. Like, this Yoga Day, International Yoga Day. The world now knows that yoga comes from India by, making it an International Yoga Day at United Nations. We have that heritage. We have also Ayurveda heritage. we are not somehow exploiting that. Other countries are. You know, there are American companies which are building drugs on the basis of this turmeric and all that. There was some time back a patent taken by some company on turmeric and all that. Why we are not doing that? This is my concern. Okay? Then final question about integrating the informal sector, MSMEs with GVCs. I think there are, you know, ways of doing that. There are ways of doing that, like just one example, you know, Pepsi Cola. When in 1993 it wanted to enter India, we were still coming out of this protectionist mindset, so we asked them, how will you help us to export? So they said that you don't have potatoes and tomatoes which can be used in our ketchup making and chips making. So what kind of tomato and potatoes you need? They are a different variety. Okay, why don't you bring that seed and allow our farmers to grow? So farmers in Punjab were given away the seeds and contract farming was done. They started to grow the tomato and potato of the variety that Pepsi needed, and a lot of exports of this happened. So my point of giving this example is that there are ways of integrating even a smallest of the small farmer in a GVC. So the farmers in Punjab who are doing contract farming for Pepsi Cola are integrated with their GVC, you know. So similarly, like Bata. Bata makes very few shoes by itself. It subcontracts in Agra and Kanpur, small manufacturers who do it for their brand, you know, their specification, and then they do the branding and all. So I think if the whole process of Indian companies becoming international, global, they get bigger access to bigger market, the global market, the MSMEs also can be tagged with them and do some outsourcing for them, and this will be a win-win. So I don't think any big company of India can cater to world market or on their own. They will have to farm out something. This, you know, very good example, you go to Gurgaon, you know, there is a Maruti Suzuki plant, but around that there are 5,000 units. It's small. They're making some parts, small parts for Suzuki factory. You know, so this is how you can have an umbrella unit and then so many millions of small and informal sector. But expecting the informal sector to go and hook up directly with the multinational won't happen, you know, because they don't have the bandwidth. The multinational big companies do not have the bandwidth to talk to 1,000 Indian MSMEs because they want them to help. They are not in this business of helping anybody. They want to make, you know, what goes to their pockets. So that would be my answer. I don't know if it answers your question, but.
Okay, so if there are no other questions, any other question? Okay, so thank you, Professor Nagesh Kumar, for this very brilliant lecture, and thank you for coming and giving this lecture.
Well, I must say that it was a pleasure, as I said, an honor to have this opportunity to speak in honor of Professor Mohanan Pillai. I'm sorry that he is not with us, but I know that he left a very important body of work along with Professor K.K. Subramaniam, which will continue to guide several generations of researchers in India and beyond. Thank you very much for giving me this opportunity.
Yeah, just wanted to say a few words of thanks on behalf of my mother and the entire family. I would like to Thank you all. Sir, thank you for the brilliant, impressive lecture. To all of you, Professor Mohanan Pillai would be a colleague or friend or mentor. But to me, my acha, he was very passionate about knowledge, about reading. And CDS is very close to his heart. And it is his second home. Thank you, Professor Veeramani, sir, for not only organizing this lecture, but for making his academic spirit alive. To all those who joined online and in person, thank you. Acha is not here as in person, but his spirit lives on, and his legacy lives on through these kind of lectures, his works, publications, the students he mentored, and the immense love that he has left behind. Thank you.